Hey everyone, and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. This week, I'm speaking with David Allen, who's the Managing Director at Octane Investments, and he's also the Chair of the Board of Directors for the CFA Society of New York, which has 11,000 members. David, thanks so much for joining me.
Thanks for having me. Pleasure to be here.
So, David, you have an energy ETF, which I want to get more into in a bit. But before we get there, I want to talk a little bit about the fundamentals of the oil and gas market. I just looked, and WTI is in the 70s, and I think it's been there for a while. And while natural gas is something like $2 per million British thermal units, can you talk about a little bit about, what do the fundamentals look like for the energy markets today?
That's a great place to start because obviously it's key to how the underlying companies should perform in the sector. If you look at the big picture, there's been a bit of a pennant formation in crude, which is the most important energy commodity, obviously. If we start at, let's call it 50,000 feet, we think about, what is exploration looked at? What does exploration look like? What does the CapEx cycle look like? And I think it behooves us all to take a view of what has happened in the last 10 years. So what happened in 2015, 2016, let's call that the middle of the shale era. You had the Saudis turning on the spigots and frankly, people in the Permian Basin producing way, way too much. Now, I think Wall Street is partially to blame for that, because Wall Street sent tens of billions of capital down to the shale producers. And what did they do? They bought expensive acreage and they poked more holes in the ground. What happens when you do that? You overproduce. What happens with overproduction? The commodity falls. And so there was this, in the middle of the shale era, it's the Aubrey McClendon days, where they overproduced. A third of the companies went bankrupt and crude went way down. So that was lesson number one. Lesson number two came only 48 months later, something we call the pandemic. And what happened there was demand in the developed world crashed. It rebounded somewhat quickly with all the stimulus and sort of back to normalcy. But that period was also a period where ExxonMobil traded in the 30s. This morning, it's $118 a barrel. And crude, actually the front month of WTI, traded negative for one day in the second quarter of 2020. And so again, what that did was it scared both investors as well as the C-suites in Houston and other oil producing places. And so what's happened since then is a return to sanity. And what they're doing, and you can see this when you look at payout ratios of these companies, when you look at, there's now a variable dividend for a lot of the upstream companies. A lot of the good refiners are, if they have a lot of free cash flow, what are they doing? They're buying back shares. And that's just really magical when you look at, when you put on your securities analysis hat and you look at share buybacks, dividends versus share buybacks, they're both pretty nice, but share buybacks are really sending an important signal for they believe their shares are cheap. They also believe in the next 3, 4, 5 years that a great place to put capital is their current shares. So when you see some of these companies, upstream, midstream, and downstream, actually lowering the share count so that existing shareholders are getting more of a pie, the pie doesn't necessarily have to be growing for their returns to be increasing as they decrease the share count. So from a big picture perspective, we believe that CapEx is under control. We believe that the C-suite, the people, at least in the public companies, are really keeping control on how they're expending capital. And therefore, we don't think there'll be too much supply there. From a really macro picture, I can tell you, and I bet my career on this, and this is, I think, as plain as day to anybody who's looking at the next, call it 5 to 10 years. The narrative has been, and I know we're going to talk about ESG in a sec, the narrative has been, how will the sector manage peak demand? So you look at the IEA, they talk about, well, coal demand is peaking, Demand for hydrocarbons are peaking. There's a very successful technology ETF investor. I won't say her name, but she said a few years ago that crude will go back to $22 a barrel based on EV adoption. Okay, I'm sorry, I disagree. It's just not going to happen. And so everybody, especially people on, let's call it left of the political center, a lot of your coastal public defined benefit public pension plans have fully divested from the space based on the theory that, well, this is a stranded asset. We can't invest in these companies. They'll be worth zero. There's no terminal value. Typically, if you're a value analyst or a value PM, you say, okay, what's going to happen in the next 60 months? And then we'll assign a terminal value at the end of 5 years based on a DDM, right? So if you believe in the argument that we're going through a cycle, the narrative of peak demand, then you are tempted to assign a terminal value of zero to these companies. And here's the grand irony. A lot of these companies were trading so cheaply, it didn't even matter what the terminal value was. They were cash flowing in the next 60 months to pay back your initial equity investment. And the most crazy example of this was a firm. It's a coal company. We own it. They were trading at about 1 to 1.5 times price to cash flow in the depths of the pandemic. If you look outside of North America, look at Indonesia, look at India, look at any of the developing world countries, they have a voracious appetite for all the above, including, by the way, solar panels and wind turbines. But their coal consumption is only going to go higher. When I speak with allocators in the U.S., they say, well, we are retiring our thermal coal fleet, and that's true. But coal is, as of this quarter, still 11% of U.S. energy consumption. We're not retiring these things overnight. And when you study renewables, what you can say with certainty is that they're actually decreasing grid reliability. But coal is the greatest asset for grid reliability. So those retirements may be a little bit on pause. But let's go back to the microeconomics of these companies. One company in particular has shifted its the demand base from 2/3 U.S. utilities to 1/3 U.S. utilities, from 1/3 seaborne exports of their thermal coal to 2/3. So the people running these companies they're not dumb. They're not lying there in the dark, hoping that somehow the U.S. policy will change. They are shifting to an export mentality, and the world is eager for their hydrocarbons. So we could talk a lot more about that, but let's just go back to your fundamental question. What are the fundamentals for oil and gas today? The narrative will shift slowly but surely in the next 5 years from the narrative of peak demand to a narrative of peak supply. Let's talk a little bit about that. Let's talk about India, which has, I believe, recently surpassed China in raw population. Today, in North America, Japan, South Korea, much of Northern Europe, we consume about 20 barrels per capita per annum of oil. India consumes about 1.5 barrels per year per capita. Let's say that India doesn't quite come up to the OECD level of middle class as we define it. Let's say they don't go to $20 barrels per capita per annum. Let's say they only go to 10. That will take global consumption from 100 million barrels per day to 145 million barrels per day. That's just India going from 1.5 barrels per capita per year to 10. That will happen in my lifetime. That's leaving out Africa, by the way, which is growing a lot, and they only consume 1% of global hydrocarbons. That's Africa. Add in the Indonesias and so many other countries that if they're not going to be in the developed world in the next 15 or 20 years, they're not going back to 0 barrels. So this is the explanation. And the demographers, the sociologists say that demography is destiny. You can't argue with this demography, and these people aren't going back these people aren't going to listen to. I'm sorry, John Kerry. John Kerry flies around in a Gulfstream, wagging his fingers at countries who consume less than 5% of what the U.S. does, and he says, "Well, when you get rich, don't consume more hydrocarbons." They're not going to listen to him, nor should they. They also received a pretty bad lesson. I believe it was Bangladesh, who had these long-term LNG contracts with firms who were exporting LNG, basically liquefied natural gas, out of the Gulf Coast of the United States. And Russia attacked Ukraine, and people in Northern Europe called these exporters in the US. The exporters broke their promise to Bangladesh. You can look this up. Bangladesh learned a lesson. Bangladesh was trying to do all the right things with their agricultural sector, with reducing their reliance on coal. You know, coal has 3 times the carbon emissions and a lot of other emissions like mercury. It's not clean stuff. So Bangladesh said, okay, well, we sort of agree with the Davos crowd, the UN crowd. Let's get cleaner. We'll spend a little bit more money. 2 things happened. Their agricultural plans failed, and then Northern Europe forgot about saving the world and learned about saving themselves, diverted gigantic LNG shipments to themselves. The people exporting these things broke the promise to Bangladesh, and the developing world will never forget. And so I think they're tired of listening to first worlders in Davos lecturing them about what they should use. By the way, China, look at China. They're all the above, and not all the above in a flippant way. They need to put renewables in because they don't have a lot of hydrocarbons in the ground there, and they want to develop their middle class. So how do you do that? Well, you produce a lot of EVs and you power them without hydrocarbons. So it's just a very rational approach for a country that, you know, we always say in the capital markets, China needs to grow rich before it grows old. They're suffering from their own challenges with their one-child policy that was instituted in the 1980s. And they have this upside-down pyramid. So these are some really big picture ideas around how we believe at Octane the narrative will shift from the peak demand narrative to a peak supply narrative. Just quickly, I'll close out that by saying the Permian is producing about 4 million barrels per day. That's 4% of global supply. We think in the next 3 to 5 years, the Permian will start flatlining and then getting a little bit tired going into 2030. Now, when that happens, and you know, U.S. production is down, call it 20-25%, the world will stand up and realize what an incredible swing producer the U.S. was in fracking. You know, those fast cycle barrels are about 2/3 of U.S. production, and U.S. production is something on the order of 10 to 12 million barrels, Permian being 1/3 of that. To put it in perspective, Saudi is about 8 million barrels. So if and when U.S. fracking gets a little bit tired, production has been great because we've been widening the straw. We're not creating any more easy to get to hydrocarbons. And so that's going to be a very interesting theme in the next 5 years. We talk about some deep water discoveries in West Africa, off the coast of Brazil, Guyana, Suriname. But these things are tiny. I mean, these things will take 5 to 8 years to develop at great cost. But you're talking about maybe 400,000 barrels a day, maybe 800,000 barrels a day. What does it take to replace 4 million barrels a day from the Permian? A lot of big, fancy headline discoveries. So this is something that will slowly unfold. And a final point on the outlook, if you look at the futures curve for WTI, what you'll see is backwardation, the front month being, let's call it 76 today, December 29 being about 63. If our thesis is right, we'll go from gentle backwardation to something much different, contango, which actually, if you look at the finance books, contango bakes in the cost of carry. So right now in backwardation, that futures curve basically says, yeah, we'll eventually find other hydrocarbons. We'll find more basins. We'll find cheaper basins. We don't think so. We're not a peak hydrocarbon. We're a peak cheap hydrocarbon shop. And so we think that curve will go from this to like this gently, but it'll take 5 or 8 years. And that's a combination of easy, cheap fracking barrels getting harder to find as we get through tier 1, get to tier 2, tier 3, which is more expensive and less efficient to get to, combined with the inexorable demand growth from the developing world.
So, David, you make a pretty compelling case for why now is a good time to, take a look at the energy sector. Sounds like, the fundamentals for oil are still strong, and the energy companies themselves are being much more shareholder friendly. Can we talk a little bit about energy ETFs? I know you have an ETF called the Octane All Cap Value Energy ETF, ticker symbol OCTA. How does that compare to something like a broad energy ETF market cap weighted like an XLE?
Well, that's actually part of the reasons we founded Octane. We saw a gap, frankly, in the product offering for these things. And, I've talked to a lot of RIAs. I've talked to single family offices, multifamily offices. I've talked to endowments that haven't divested from fossil fuels. And they say one thing. And actually, Prudential Asset Management wrote a good white paper about 2 months ago. And they talk about how energy is 10% of global GDP, but the other 90% relies on cheap, dispatchable, reliable energy, right? It makes sense. Here's the conundrum. Because of divestment, because the sector is volatile, because it's had its bumps and grinds through the shale era and even the pandemic, it's only 3.6% of the S&P 500. So we talk to all these allocators, they agree that there's a structural underweight in energy. And a really good way to top up your energy beta is going out and buying, as you mentioned, the XLE. Now, why? The XLE has about 40 billion and it trades about $1.5 billion a day. So if you were running a $4 billion multifamily office in San Francisco and you looked up and said, my gosh, we're actually short about $200 or $300 million of energy beta within your public market security, you just go out in a couple of hours. You could top that up by buying the XLE. And the XLE is a wonderful way of topping up your growth beta. And by the way, if ExxonMobil is trading at $32, you should buy the XLE. But here's the thing. The large cap energy firms have re-rated. They're trading between, let's call it 10 and 15% price to forward earnings. Now that's at a steep discount to the rest of the portfolio of the S&P 500. And it's been tamped down because people are sort of afraid of investing in energy. We look at the vast valuation gap between large cap and what you can get in an all cap portfolio. We think that's between 40 and 50% discount. And that's where we think that we can call structural alpha by looking at the world and energy sector from an all cap value perspective. Now, the other fun thing about looking at the world from an all cap value perspective is we can buy ADRs of developed world companies. And so when the live track record started in November 1st of 2022, the ETF just launched on August 1st of 2024. That's a week ago. But we've got a live track record going back to November 1st of 2022. When we looked at the market and we said, you love the integrateds because in theory, they're going to be less volatile. The US integrateds didn't look cheap from a value perspective. You know what looks cheap? The international oil companies of Europe. And I won't say their names, but they're trading at perennial discounts to the US super majors because so much passive money is going into the super majors. And there's typically a European discount anyway, because US investors are wary of, they sort of think it's a museum or a graveyard. But these companies are making a lot of money. These companies are national champions. And these companies are completely embedded in commerce writ large of these of continental Europe. There's a very good, I won't name it, but there's a very good website, and they track everything. They track every mutual fund. They track every ETF. They track every publicly traded company, and they assign to the U.S. Integrateds a narrow moat. These champions over in Europe, in France and Italy and the Netherlands, there's no moat at all. And what an inversion. The US majors are much more susceptible to non-monopolistic markets as opposed to the Europeans. There's no moat on this one continental European. They have 100,000 employees. Every piece of 80% of hydrocarbons goes through this national champion, and it just dividends and dividends and dividends and dividends. Now, a few of the European national champions I'm not invested in because they've gone way over their skis on non-returning, non-economic projects like a 20-year hydrogen project, which is just doesn't make any sense for ROEs or return on capital employed. It just doesn't make much sense at all. And so with all cap value, and I wrote a white paper on this, it's called Somewhere Under the Radar. And I talk about the widget manufacturing industry. And you can actually look at the pull, the valuation pull of passive versus active. And you can have $100 billion company, integrated company, that's in all the indices. It's in the MSCI world. It's in the Russell 1000. It's in the SP 500. And it's pulled away from its much smaller cousins in the same industry because 95% of target date money is going into passive. A lot of the huge allocators say, core satellite, we're going to get passive through State Street at 2 basis points, and we're going to spend our fee budget with private equity. The point is, passive is such an incredible force in the capital markets. It's driven a gigantic gap. And David Einhorn, the hedge fund star, commented last year. He said, the problem with machine money is it's breaking the market because machine money, passive, only cares about price and doesn't care about valuation. That's exactly why Octane Investments is in existence.
Fantastic. Well, we have time for just one more question, David, but I really want to get to this one because it's very topical. A lot of people look at the energy sector and they think, Republicans good for fossil fuels, Democrats bad for fossil fuels. Is that, accurate, or does it even matter who's in Congress and who controls the White House when it comes to investing in the energy sector?
Well, I love that question. It's, of course, on everybody's minds today. The crazy conundrum is that the current administration promised in New Hampshire in 2017 on the campaign trail that they would end fossil fuels. You probably look up the video of that. Under this administration, there has been more production than any other prior administration, which is very interesting. The question is that on the upcoming election, a new administration would probably be friendlier to upstream activities. I think everybody agrees with that. But what do you get from a friendlier regulatory environment from upstream? Okay, so you let them go back on federal lands. You don't increase fees on federal lands. You probably have all else equal, you have a softer commodity environment. All else equal. We're talking about WTI here. I'm not projecting that the crude goes down to 60. I think there's going to be too much demand for it to go down to 60. But if I had to choose under which administration you would have a softer WTI, it would be a new administration. Here's the second leg to my answer to your very important question, which is this. What does the IRA do? The IRA says $12 billion for EV charging stations, okay? More and more subsidies for wind and solar, more and more subsidies for EVs. If the IRA is denuded by the new administration, you have removed a lot of the threat to internal combustion engine vehicles. So let's put those two ideas together, and this is Octane's view on the election. If you have a slightly softer commodity, all else equal, and is upstream WTI, and we are mitigating a large threat to gasoline consumption, meaning the defanging of the IRA, what I believe you have is a very solid foundation for refiners, right? So you're helping support gasoline demand. You're probably tamping down supply, any supply problems with crude. And I can tell you, new administration or not, we are not building any more refiners. Full stop. Not in this country anyway. I know China's built a lot. I know Africa's trying to get one going. MX is trying to get one going. They keep failing. Sorry, but they do. And so if you have a constructive environment for refiners and perhaps a softer environment for WTI, I like the crack spread, and I like leaning into refiners. But this is not investment advice. This is for informational purposes only.
Well, David, that's great. This was a fascinating discussion. Really appreciate your time. We're going to have you back on sometime in the future.
Thank you, Sumit. It's fantastic to meet you. I appreciate your time.